JP Morgan just published their case against gold. Their argument: central banks could stop buying, retail investors could abandon it, and the rally could reverse as quickly as it started. They're not wrong that these are risks. They're wrong that these risks matter. In fact, I'm going to show you that every argument JP Morgan makes against gold actually strengthens the case for owning it. Because when the world's largest bank has to work this hard to find reasons gold might fall, and the best they can come up with is, what if everyone stops buying? That tells you something. It tells you they can't find fundamental flaws, only hypothetical scenarios that contradict every trend currently in motion. Let me walk you through their argument and show you exactly why it falls apart. First, let's acknowledge what JP Morgan gets right. They correctly identify that gold has had a ferocious rally over the last 5 years, up over 170%. Actually, from the March 2020 bottom to today's 5042, it's up even more than that, closer to 200%. They correctly identify the drivers: geopolitical volatility, currency debasement concerns, inflation fears, and irresponsible fiscal finances. They correctly note that gold outperforms during major geopolitical shocks, averaging 1.8% returns during crisis periods while other assets fall, and they correctly identify the two main sources of demand: central bank buying and retail investor accumulation. So far, so good. JP Morgan's research team did their homework, but then they make a critical error. They ask, what stops gold's rally? And their answer reveals the weakness of the entire bear case. They propose two risks. Risk 1, central banks stop buying or start selling. Risk 2, retail investors turn their backs on gold. Let me address both, starting with the central bank argument because it's the more interesting one. JP Morgan's first concern: what if central bank demand waned? Or worse, what if they wanted to outright sell the commodity? They point to historical precedent. The United Kingdom sold over 50% of its gold holdings between 1999 and 2002. Switzerland delinked the Swiss franc from gold. Gold fell 13% in 3 months. That episode is now famously known as the Brown Bottom, named after Gordon Brown, the UK Chancellor who authorized the sale at what turned out to be a multi-decade low in gold prices. It's taught in finance classes as one of the worst timed asset sales in modern history. The UK sold gold at an average price of $275 per ounce. Gold today, $5,042. The UK literally sold at the bottom and cost British taxpayers tens of billions in foregone value. So yes, central banks can sell, but should we expect them to? JP Morgan's own research answers this question: no. Let me read directly from their report. As of 2025, 95% of central banks expected global gold holdings to increase, with 5% saying unchanged and none of the respondents expecting a decrease. None. Zero. Not a single central bank surveyed expects gold holdings to decrease globally. JP Morgan acknowledges this. They write, rest assured it's unlikely to happen, at least not anytime soon. So their first major risk is one they themselves dismiss as unlikely. That's not analysis, that's searching for bearish arguments and coming up empty. But let's go deeper into why central banks won't sell, because this is where the bull case gets even stronger. JP Morgan notes that emerging market central banks hold gold at only 19% of reserves, compared to 47% for developed markets. China, the world's 7th largest gold custodian, has gold representing only 8.6% of total reserves, according to the World Gold Council. And we know from recent revelations that even that number is probably understated. Remember the announcement that China had been underreporting reserves for years, revealing actual holdings of 14,000 tons instead of the reported 2,000? JP Morgan's report was written before that bombshell, so their 8.6% figure is based on the old false data. The real percentage is much higher, and even at the real level, China has massive room to increase gold allocations if they're targeting anything close to the 19% emerging market average, let alone the 47% developed market average. Poland holds gold at a higher percentage than China, India too. Brazil is increasing allocations. These aren't small countries. These are major economies representing billions of people and trillions in GDP, and they're all buying gold for the same reason: diversification away from the dollar after the United States froze Russian assets in 2022. JP Morgan acknowledges this. Central banks have fueled demand for the precious metal in efforts to diversify reserves away from the US dollar. So let me get this straight. The structural reason for central bank buying, de-dollarization, and reserve diversification is accelerating, not decelerating. The countries with the lowest gold allocations relative to reserves are the ones buying most aggressively, and 95% of central banks expect holdings to increase. But JP Morgan wants us to worry that maybe, hypothetically, central banks might stop buying or start selling. That's not a risk. That's a fantasy scenario invented to justify a bearish take. Now let's address their second risk, retail investors turning their backs on gold. JP Morgan points to the volatility in late January 2026, when gold shot up 20% in a week before crashing by the same margin in 2 days. I remember that week. It was wild. Gold went from 4,100 to 4,900 in 5 trading days, then pulled back to 4,200 in 2 days. Retail panic buying followed by retail panic selling, right? Wrong. That volatility was driven by algorithmic trading, leveraged futures positions getting liquidated, and options expiration dynamics. Retail investors who owned physical gold or ETF shares didn't create that move and didn't participate in it meaningfully. But more importantly, JP Morgan's own data contradicts their retail concern. They show that global gold ETF holdings, their proxy for retail demand, stand at about 100 million ounces. They note this is only 8% of global central bank holdings, and still below the record were 110 million ounces recorded in 2020. So retail holdings are below all-time highs. A tiny fraction of institutional holdings, not at levels that would indicate bubble behavior, and yet JP Morgan warns that retail could drop the metal as quickly as they picked it up. Based on what evidence? Retail gold ownership is lower than it was in 2020, despite gold being 50% higher in price. That's the opposite of a retail-driven bubble. That's retail underweight gold even as the asset appreciates. If anything, this data suggests retail has more buying to do, not selling. Let me show you why JP Morgan's concerns are not just wrong, but backwards. They're worried about central banks selling, but central banks are accelerating purchases because the dollar system is under structural stress. The U.S. has $36 trillion in debt, interest payments exceed income tax revenue, the debt ceiling fights are becoming more frequent and more dangerous. Europe has the ECB crisis we've discussed. Italy at 140% debt to GDP, bond yields rising, structural insolvency barely contained by unlimited bond buying. Japan has debt to GDP over 260% and is still running deficits. China is dealing with property collapse, demographic decline, and slowing growth. Every major reserve currency is issued by a government with unsustainable debt. In that environment, why would central banks sell the one asset that has no counterparty risk, can't be printed, and has maintained value across every currency crisis in history? They won't. They can't. The system requires them to keep buying. JP Morgan's own report acknowledges gold makes up only 19% of emerging market reserves. That means 81% is everything else: dollars, euros, yen, bonds, other assets. If you're a central banker in India or Brazil or Poland, and you're watching the dollar lose purchasing power, watching US debt spiral, watching the Eurozone crisis intensify, are you going to sell your gold, the one asset in your portfolio that's actually working, or are you going to increase gold from 19% to 25%, 30%, 40%? The answer is obvious. Now let's talk about why JP Morgan is publishing this research in the first place. Banks like JP Morgan make money from transaction fees, underwriting, asset management, and lending. Gold generates none of those revenues. If you buy physical gold and store it, JP Morgan earns nothing. If you buy a gold ETF, they earn a tiny expense ratio if they manage the fund, but that's minimal. Compare that to what they earn if you buy stocks, trading commissions, payment for order flow, prime brokerage fees, buy bonds, underwriting fees, dealer spreads, management fees, take out a mortgage, origination fees, interest income, invest in private equity, management fees, carried interest. Every product the financial industry wants you to buy generates recurring revenue for them. Gold does not. So when JP Morgan publishes research saying, here are the risks to gold, what they're really saying is, please don't allocate too much to the one asset we can't monetize. This isn't conspiracy. This is basic business incentives. They're not evil. They're not lying. They're just structurally biased toward products that generate fees. And gold doesn't generate fees. Here's what JP Morgan's research actually reveals when you read between the lines. They acknowledge gold has rallied 170% and is driven by legitimate structural factors: geopolitical fragmentation, currency debasement, fiscal irresponsibility, inflation. They acknowledge central banks are buying aggressively and 95% expect holdings to increase. They acknowledge retail holdings are below 2020 peaks, despite prices being much higher. They acknowledge gold outperforms during crises and serves as a portfolio diversifier. And then they say, but what if all these trends reverse? That's not analysis, that's wishful thinking. The trends won't reverse because the underlying drivers are worsening, not improving. Geopolitical fragmentation is accelerating. The BRICS nations just expanded to 15 additional countries. The dollar's role as sole reserve currency is ending. Currency debasement is guaranteed. The US cannot service 36 trillion in debt without inflation. The ECB cannot save Southern Europe without printing. Japan has no exit from its debt trap. Fiscal irresponsibility is bipartisan and permanent. Neither US political party has any interest in balancing budgets or reducing deficits. The spending will continue until crisis forces austerity. Inflation may fluctuate year to year, but the long-term trend is higher prices because the long-term trend is more money printing. Given all of that, why would central banks stop buying gold? Why would savvy retail investors abandon the one asset protecting them from these trends? They wouldn't. Let me give you the framework JP Morgan should have used but didn't. The question isn't, what could stop gold's rally? The question is, what would need to happen for gold to sustainably fall? And the answer is, the US would need to balance its budget and start paying down debt? Not happening. Politically impossible. Europe would need to resolve its structural banking crisis and fiscal divergence between North and South? Not happening. Requires political integration that doesn't exist. Japan would need to grow its way out of debt or default and restructure. Not happening. Demographics make growth impossible, and default is political suicide. China would need to stabilize its property sector, reverse demographic decline, and resume export-led growth. Not happening. All three trends are worsening. Central banks would need to stop diversifying away from the dollar, despite watching the US weaponize currency via sanctions. Not happening. De-dollarization is accelerating. Retail investors would need to trust that stocks, bonds, and real estate will preserve purchasing power better than gold. Not happening. Those asset classes are all overvalued relative to historical norms and all denominated in depreciating currencies. Every single condition required for a sustained gold bear market requires reversing trends that have been in motion for decades and are accelerating. JP Morgan's bear case requires a miracle. The bull case just requires the status quo. Now let me address the one legitimate point buried in JP Morgan's research. They note that gold shot up 20% in a week before crashing by the same margin in 2 days in late January. That volatility is real, and it will happen again. Gold is not a smooth ride. It gaps up, pulls back, frustrates holders, creates doubt. If you can't handle watching your gold position drop 15% in 3 days, you shouldn't own gold, or you own too much. The proper allocation to gold is the amount you can hold through volatility without panic selling. For most people, that's 10 to 15% of portfolio. Maybe 20% if you have high conviction and strong hands. Not 50%, not 70%, and certainly not leveraged positions that force you to sell during drawdowns. JP Morgan is correct that short-term traders and momentum chasers will get destroyed by gold's volatility, but that's true of any asset. Short-term traders get destroyed by oil volatility, by equity volatility, by bond volatility. The solution isn't to avoid the asset. The solution is to size your position appropriately and hold through the noise. Gold at 5,042 will probably pull back to 4,500 or 4,200 at some point. Maybe next month, maybe next year. That doesn't invalidate the structural bull case. That's just volatility. The people who will lose money are the ones who buy at 5,000, panic sell at 4,300, then watch it go to 6,500 and kick themselves. The people who will make money are the ones who buy at 5,000, hold through 4,300, and still own it at 6,500. Position sizing and emotional discipline matter more than entry price. Here's what I want you to take away from JP Morgan's research. When the smartest analysts at one of the world's largest banks are tasked with making a bear case for gold, and the best they can come up with is, what if central banks stop buying even though 95% expect holdings to increase? And what if retail investors abandon gold even though holdings are below 2020 peaks? That tells you the bear case is weak. They're not pointing to fundamental flaws. They're not showing overvaluation. They're not demonstrating that the structural drivers have reversed. They're just saying, what if the trends that are clearly in motion suddenly reverse for no reason? That's not analysis. That's desperation to find something bearish to say, and the reason they're desperate is because the bull case is overwhelming. Gold is repricing because the monetary system is failing. Central banks know it. Savvy investors know it. Even JP Morgan knows it. They just can't say it directly because they're institutionally committed to defending the system. But you're not institutionally committed to anything. You're an individual trying to preserve wealth through a monetary transition, and the asset that preserves wealth through monetary transitions is gold. Not because of conspiracy, not because of manipulation, not because of retail mania, because gold is the asset that works when the system doesn't. JP Morgan made their case against gold. They argued central banks might sell, but 95% expect holdings to increase. They argued retail might abandon it, but holdings are below 2020 peaks despite higher prices. They argued volatility could scare investors, but volatility is a feature of every asset and doesn't invalidate fundamental thesis. Their bear case requires miracles. The bull case requires status quo. I know which one I'm betting on. Gold isn't going to 5,000 because retail is piling in. It's going to 5,000 and beyond because the monetary system requires it to reprice that high to maintain even minimal stability. JP Morgan can publish all the bear cases they want. The central banks will keep buying. The fundamentals will keep deteriorating, and gold will keep doing what it's done for 5,000 years, outlasting every currency, surviving every crisis, preserving wealth when nothing else does, position accordingly.